A lot of people ask me about NVidia. It's like the most popular stock right now. It's exceeding Tesla, which used to be the most popular stocks. And NVidia has earnings coming up next week. So it's a risky period of time to be holding NVidia. That being said, the stock has corrected about $50, right, over the last couple of months. And it is now it's in a short-term downtrend, but a medium-term and long-term uptrend. And so you want to try to catch this stock and sell covered calls against it to create some income. In this video, I'm going to show you how to create about 6-7% of income in just less than a week. So here we go. Okay, so today is the 19th, which means in 9 days, which is, like 7 trading days, we have a report coming out from NVIDIA. Let's take a look at this chart, and you can see that NVIDIA has been in a short-term downtrend. Long-term uptrend, but a short-term downtrend. So what we want to do is we want to maybe capture an early entry, because this stock may, I'm not saying it will, I'm saying it has the propensity of maybe running up based on all this hype going into earnings. Now, of course, it depends on the market, and the market's green right now. So the probabilities are starting to stack in favor of the stock being more bullish going into earnings. We'd rather have the stock not go down. We don't care if it goes up that much, but we'd rather have it not go down, right? And stay the same or go up is what we're going for here, because we're doing covered calls on this stock. So let's take a look at the chart. Short term, we have this little downtrend. And so you could see this, I've drawn this little line right here. This is an early entry. The real entry here is around 141. If we have to wait till that happens, and that could happen on the day it makes earnings, this stock could easily open at 150 or it could open down below 100. I mean, it's that kind of stock. So I'd rather not give us too much exposure going into numbers. So here's what I would look at doing. There is a little spot on the chart right here that I would say is the one we're going for. It's about 128, right? The stock today is around 125. So if we can get this stock to get to 128, chances are it will break through, hopefully, with all the market tailwinds that we're getting, and go to 140 and then break out from 140. That's what I see here. Now, the risk is this is a later stage base. We've gone up, we've consolidated, we've gone up, we've consolidated, we broke out, and now we're in this third stage base, which is a little bit riskier base. What I'm suggesting here is take a shot at getting in this early. Now, do your research and all that stuff. This is for education and information in the beginning of your research, not the end of it. But take a shot at getting in early. Getting in here at 125 up until 128, something like that. And then hedge your bet by selling calls, covered calls against this stock. Okay? And so if you do that, you can make a good percentage. Let me show you how that works. So if you look at this option chart, and if you don't know about options, then you should watch one of my other videos. But basically, you're agreeing to sell your stock to somebody else at a predetermined price before a predetermined date. Now, I'm going to go out, instead of going out these 3 days, I'm going to go out next week. Now, we have earnings on the 28th. So I don't want to hold this all the way. What I want to do is I want to hold this until the 28th or 27th and get out of this trade. Now, I'll be able to collect most of this juice if the stock stays the same or goes up. If it doesn't, I'm collecting a little bit of hedge and a little bit of cushion. So the stock right now is about 125. You can see that right there, 125.08. So what I'm going to do is I'm going to go one strike out of the money. If I go one strike of money, I'm going to buy the stock for 125, whatever it is here, and I'm going to sell the call. You can see the calculator does the work for you. You see where it says $7.13? That's the maximum upside if I sell the 125s. I'm going to sell the 126s, just a little bit out of the money. So my maximum upside is $7.63. If you look at that, it's 6.1% on this trade. And this is a 9-day, an 8-day trade, something like that, because we're not going to hold it all the way to completion. We're going to trade it and get out of it, and it's about a week-long trade, and we're going to make 6%. It gives you the annualized number if you hold this all the way to term at 222%. But we're not going to hold it all the way to term. We're going to just try to make that number. Let's say we just get half of that, or let's say the stock goes down the other way. Well, if it goes down the other way, we're collecting $6.85 worth of juice, which allows that stock, if we get in here around 125, to go all the way down to 119 before we start to lose money, roughly around there. So the covered call strategy really does a couple of things. Number one, it gives you upside protection by taking advantage of the gambler, the person that's willing to buy the option from you to sell the stock that you have to them. number one. And number two, it gives you that downside cushion. That's probably the most important part of this. We want to make the $6.80 or whatever it is on this trade, certainly. But at the same time, we also want to protect our downside. And so that's really the covered call trade in a nutshell. If you like this video, like what we're doing here, you can subscribe to my free newsletter called Insider Tips. Just go to the first link at the bottom here, and then you can be up to date on all the things that we're doing here. And you'll even get some exclusive videos just because you're on that as well. So sign up to that, and I'll see you on the next video. Take care.